The day the banks closed, how history repeats when trust runs out. 1. The illusion of safety. It begins like any other day: coffee, headlines, maybe a glance at your bank app. But imagine that screen not loading. The ATM says out of service. The grocery store wants cash only. You laugh it off, at first. Then the laughter fades. The neighbors are lining up outside locked bank doors. Panic has a smell: paper, sweat, and disbelief. This isn't fiction. It has happened. And not in failed states or distant economies. In Argentina, 2001, Cyprus, 2013, Lebanon, 2019, and even the United States, 1933. Each thought they were modern, stable, too advanced for such chaos. Each discovered the same truth: your money is only real as long as the system stays awake. So what does that actually mean? It means your balance isn't a vault. It's a promise. And promises get broken when confidence does. Footnote. History shows that even the strongest economies have shut down banks to preserve the system, not the people. 2. The corral and the cage. In Argentina's 2001 corralito, citizens could only withdraw 250 pesos per week. Overnight, dollar accounts were converted into pesos worth half as much. Imagine saving for decades, then watching your purchasing power vanish before breakfast. The same pattern unfolded elsewhere. In Cyprus, depositors had funds bailed in to rescue banks. In Lebanon, withdrawals were rationed to a few $100s a month. Governments called these measures temporary. People called them theft. Pots banged in protest. Streets filled with fury. It wasn't just money lost, it was trust. Footnote. Bank restrictions, whether called controls or bail-ins, are mechanisms to protect institutions by freezing the public's mobility. 3. The Great American Pause. Even America hit the switch. In 1933, facing the Great Depression, every U.S. bank shut down for 4 days. The government called it a holiday? No one celebrated. Salaries stopped. Checks bounced. For a nation built on abundance, it was a cold reminder: wealth isn't what's printed, it's what people believe still holds value. When the banks reopened, only a few were certified safe. The rest quietly disappeared. Confidence was restored, but only because people had no choice. Footnote. The U.S. bank holiday of 1933 proved that confidence, not currency, is the true foundation of modern finance. 4. The fractional fantasy. Here's the part no one likes to think about: banks don't hold your money. They lend it. They multiply it. They transform it into credit. It's called fractional reserve banking, a clever way of saying we keep a little and loan out the rest. If everyone withdrew at once, the vaults would echo. So what does that actually mean? It means every financial system runs on faith. Lose faith, and the math falls apart. That's why governments rush to freeze withdrawals, not because they're cruel, but because they're cornered. Footnote. Fractional reserve banking thrives on confidence but collapses instantly when too many people test it at once. 5. The government's real customer. When crisis hits, governments don't save depositors. They save banks. It's not personal, it's structural. Banks buy government debt, governments backstop banks. They are codependent. You, the depositor, are collateral in that relationship. Deposit insurance? It's not protection, it's psychology. The FDIC in the U.S. insures accounts up to $250,000, but the fund itself couldn't cover a nationwide panic. It's a comfort blanket over a structural fire hazard. Footnote. Government guarantees are designed to calm the public, not to ensure full repayment in systemic crises. 6. The digital trap. Today, the danger isn't physical bank runs, it's digital ones. Your wealth lives on screens. Servers crash, networks fail, or policies freeze your account with a keystroke. In a cashless society, control shifts from the customer to the code. When Cyprus froze accounts, or when Lebanon throttled transfers, digital banking didn't save anyone. It simply made the freeze faster. So what does that actually mean? It means the future of finance isn't paperless, it's permission-based. Footnote. The shift to digital money increases efficiency but also centralizes control, making shutdowns faster and total. 7. The chain reaction. Once banks seize up, the economy follows. Wages halt. Imports vanish. Small businesses crumble first, then factories, then the middle class. Barter returns like an old ghost. Every past collapse, from Argentina's black markets to Greece's ATM lines, follows the same script: first disbelief, then desperation. It's not fear-mongering. It's logistics. No cash flow means no commerce. And when survival trumps civility, history stops being polite. Footnote. Economic paralysis spreads faster than political control can contain it, turning financial crises into social ones. 8. The modern mirage. The uncomfortable truth? Banks exist to preserve themselves. Governments exist to preserve order. Neither exist primarily to preserve you. Their alliance is pragmatic and ancient. When pressure mounts, they act together, and the individual saver becomes the casualty. Deposit insurance, emergency powers, and capital controls all share one goal: keep the public calm long enough for the system to stabilize itself. You pay the bill in silence. Footnote. Systemic crises prioritize institutional continuity over individual solvency. 9. The lesson hidden in plain sight. When Argentina froze savings, when Cyprus seized deposits, when Lebanon rationed cash, each nation said, "It can't happen here," right before it did. That phrase should be carved on every bank's facade. Stability is only stable until it isn't. The solution isn't panic, it's preparation. True resilience means diversification, not just across banks, but across systems. Cash, precious metals, hard assets, decentralized stores of value, these aren't paranoia. They're insurance against institutional fragility. Footnote. Historical evidence shows that financial survival favors diversification over dependence on any single institution. 10. The final question. If money is trust, then the real question isn't how much you have, it's how much trust you can afford to lose. Every modern collapse begins when that answer becomes too much. History doesn't need to repeat itself to rhyme. From 1933 to 2013, the lesson echoes: don't mistake access for ownership. If your wealth exists at someone else's discretion, it isn't yours. So what does that actually mean? It means the next bank holiday won't look like the past. It'll be digital, silent, and total. Footnote. Financial independence begins not with wealth accumulation but with control over access.